I was renting my home and wondering if I should invest in rental properties, right? And we had a bunch of conversations around it on this show, and you and I in private on our morning runs, Greg. But I knew two things. I knew that I wasn't really ready to call Jacksonville my permanent residence at that moment. And I also knew that I wanted a piece of the Jacksonville real estate market because I see a city that's becoming this like next great city in America and all the things that I saw that happened in Miami happening. So I had a little bit of cash that I had, there for a special investment. And I said, okay, I'm just going to get started with my first rental property and I'm going to figure out the rest as I go. Now, what ended up happening for me is I made a really smart investment in February of 2020. I bought into Peloton in February 2020. And as luck would have it, pandemic happens. A year later, that stock went from, I bought it, I think at like 40. I sold it at like a 121 because I wanted to lock in my returns and lock it into another rental property. So, in that way, I was just kind of lucky that I had a why. I knew I wanted to build a real estate portfolio. I ended up stumbling into like extra kind of net worth from this thing that happened. And what I decided to do, if I was to zoom out, I just kind of said, okay, man, I'm looking around. I know that I want to grow this plan. And I was afraid of what could happen if I stayed in one place. So I wanted to move it to a safer place that I knew had long upside and more stability. So I did that. And then once I did that, I was just like, man, I feel I'm really close to this like 3 home portfolio that kind of creates this like really nice diversified balance of exposure to upside and risk mitigation with cash flow and all these different things. So again, I looked around at where I was invested. I realized that I had a bunch of cash in a retirement account that I just never really felt like it was doing what I wanted it to do for me. And I made kind of like a not conventional decision to think to myself, hey, where is the market going to go here in the short term? I'm not sure what I like the indicators. This was when like inflation was raging and everybody was predicting kind of like the next crash or a next recession. I took it out of my retirement savings that I had from a past company, paid the penalty, but it was enough to buy another rental home and now have 3 rental properties. And then most recently, now that I have that going for myself, I did decide to make Jacksonville my forever home. I once again realized that there was a shift in the market in that they changed the regulations and allowed people to buy small multifamilies, 2 to 4 unit buildings with a 5% conventional loan. And as long as you live in one unit. And I said, this is it. This is my moment. I can go buy the place that I want to live in as a duplex so that I can live in one and rent the other one out. And now I'm at 5 doors and I have this kind of like self-feeding like flywheel that's happening for myself. And that
Love it,
was
man.
in a span of 3 years, right?
That's what
Three,
I
four
was going to
years.
say. 3, 4 years, it's
Yeah.
1 to 2 rentals a year, just like Shively was talking about. And yeah, I was just running your equity numbers there, Pablo. Through those investments, those 3 JWB investments, you've already accumulated over $130,000 in equity. So as we are talking
Okay.
about how, yeah, exactly. As we
Look
are
at me.
talking about how you stack these wins, how you build this army of income producing assets and the compounding effect of it, Pablo, you're living this out in real time for everybody to see on this show. Shively, you've been living this out for decades. I've been living this out for decades. Our clients are continuing to live this out every day. But it's not some unobtainable goal because, Pablo, you were doing this as you were starting your business as well, right? This was not easy for you to do, but because of your ability to be a part of this special community, it became real. You saw other people doing it.
Yeah.
And I think, you've always talked about, Pablo, your goal is to be able to use the equity buildup in your JWB rental properties to continue to build onto that next one. Well, you're somewhere pretty close to having, more than enough for a down payment for that next JWB rental property as we
No
sit here
way.
today. Yeah,
Yeah,
man.
that's surprising. That's cool.
The other thing I wanted to point out is we've talked about how getting from 1 and just 1 to 2 a year and scaling up and how, this asset works really well for that. Many people in their minds think, well, I have a really hard time getting to 1. How do I get to 1, right? Purchase prices have gone up. Interest rates are a little higher today, which means that, You have to put more down in order for it to be cash flow positive. And so it's really tough to get to one. But I say this with all sincerity that, if you surround yourself with the right people, finding the money for your first rental property should work itself out. It does with every single client. Everybody who gets on the phone with JWB and gives us enough time to put the plan together and fill your mind with all these positive concepts and ideas, if you put a little attitude and effort towards it, you're going to get there. And a couple of sources that I just wanted to share that will help you get over the hump for finding the capital for your first one. Number one, retirement accounts. So Pablo just talked about how he tapped into his retirement accounts in order to purchase his first properties with JWB. He mentioned there that he actually paid the penalty. We openly talked about that. We put that plan together. It made sense for Pablo's situation. But what I want to share with everybody here is that you do not have to pay the penalty. It made sense for Pablo because we sat down and we planned it out. Sometimes that does, sometimes it doesn't. But for all of you who have retirement accounts, maybe you don't know what they're doing, maybe you don't know how they're performing, you can absolutely use your retirement accounts to start your real estate portfolio. And you can even get loans inside your retirement account to purchase rental properties and get started there. So there's a source there that is highly misunderstood, but many clients tap into their retirement accounts. And why do they do that? It's because this asset class is built perfectly as a vehicle for a strong, stable retirement. This is a get-rich slow asset class, which is exactly what you need for retirement. It's consistent, it provides income. And so looking at those retirement accounts might get you kickstarted in finding the funds for your first purchase.
Can we expand off that as well too, Greg? Because I love that. And Pablo, I know I'm supposed to defer to you because you're the leader here, but do you mind if I jump in on that one? I just want to expand on that one a little bit, if that's
Paul,
okay.
the more that you speak and the less I speak, the smarter everybody's going to get. So go for it, buddy.
I love it, brother. Number one, I'm pumped for you, dude. That's awesome. I'm like so excited for you. I've been there. I've discovered, you just discovered $100,000. Did you realize, how does that make you feel? You just discovered
Rich.
Right?
Yeah.
Pretty awesome. Right?
Yeah.
I love it. Greg just made his day in the Philippines. I love it. But that's the power of real estate. So, and Greg, I love what you talked about. There's some sources out there that people may not think of to get started. There's also some sources that we can talk about to put fuel into the flywheel. That's kind of like how I like to say it. We're talking about creating this flywheel, right? You buy a couple, you get some cash flow from them, you build some equity in them, you can use that to buy more. And I see the questions. We'll talk about how to do that. I love that. And Pablo, we'll talk about how specifically what actions you should be taking right now. I love that. We can we carve time out for that at the end of the show. I want to add another source that people, they may think about, but they may not be armed with the tools of how to think about it, right? And that's looking at your current investments, the more traditional investments that you have, and learning how to view them and how to actually, in an educated way, compare them against your other options. And in this particular case, compare them against single family, passive income rental properties, right? How do you compare them? Because a lot of people will just say, oh, well, the stock market did X last year, and my rental properties, I'm staring at Y. And it's like comparing, it's hard for me to make an analogy. It's like apples to Coca-Cola or something, right? They're both technically food. Technically, one is sugar water and one is like a healthy, whole, nutritious food. Take that wherever you will, right? They're both food, but they're very, very different. So what people usually do when they compare their more traditional investments is they look at, and Pablo, you did it, which was great. Nothing wrong with it, right? I bought it at X and it's now Y, right? Or I've invested X dollars and I get a statement once a year that I may look at, may not look at, and my portfolio has grown X percent, 4%, 8%, 6%, whatever. Number one, also look at the fees that are being charged on that. What's the net percentage to you? I would always argue that. Number two is that's the only number they look at. And then they look at and compare that against the rental income, one of the 5 sources. And they're like, well, why would I invest into something making me 2 or 3 or 4% and against something that made 8 last year or 18 last year or whatever? Well, you're comparing apples to Coca-Cola. Let's look at all the income sources and all the income sources and compare them together, right? If you look at the rental income, you look at the growth and the appreciation, you look at the tax benefits, right? You look at the principal pay down. You look at the mitigation against inflation, as Greg taught me, right? To add that 5th one, love it, right? And you look at all of those, that comparison is often in 10 plus range easily, right? And we can show you that. We've done whole shows on that. We can get on the phone with JWB. They can educate you and literally show you how to calculate every single one of those 5 income sources. And then you are not your average investor then, like this show talks about. You are educated. You're being a good steward then, like we talked about earlier. You have the education and the tool to pull out of your tool belt and say, let me compare apples to actually apples, right? What are the cash flow dividends from my portfolio that's in the stock market or in an annuity or in a ETF, whatever, right? And neither of those are bad. I'm not saying any of it's bad. I'm saying compare it, but actually compare it, right? Is it actually producing income for you, or is it just growing in value? Oh, well, the growth in value is the second income stream over here. This one produces rental income and grows in value. Let's compare apples to apples. What are the tax benefits, right? Did you acquire any debt to help pay it down, right? Does it have any actual built-in inflation fighting things like rental escalations like we do over here? Does that automatically happen over here? And actually compare apples to apples. And when you do that, I'm not giving financial advice. I'm telling you what I have done. I actually compared apples to apples, and then I make a very conscious choice of where my money goes, right? I want to be very clear, 0 degree. You do you. I'm not giving you financial advice. I'm giving you the tools of how to analyze your portfolio. And when you do that, a lot of people make a choice to make a different decision. But that's your job. Take that education and actually do it. Apples to apples. Greg, does that make sense? Anything you want to add?
I love it, brother. I love it. This is just a plea for everybody listening to do your own due diligence, right? To be a good steward of your money, to mind your own business, right? To understand how your money's working, because most people don't. And I love how you were talking about comparing apples to Coca-Cola, right? Let's go. I want to do just a simple example with everybody, just to show you many times how things are misunderstood. Okay. When we hear of one asset earning a 10% return, and we hear of another asset, which is real estate, growing, appreciating at 4% a year, you're saying, well, geez, 10% is better than 4%. But let's dive into this a little bit. Okay. I'll show you how 4% can be better than 10%. All right. So we've all got cell phones here handy. Bring out your cell phone here. Let's say that you bought $100,000 of an asset, right? That you can't use leverage on, right? You know many assets you can't use leverage on. So let's say that you bought $100,000 of an asset and it went up 10%. You put $100,000 in your cell phone times 0.1. That means that you earned $10,000 for that year. All right. That's your 10% return. But if you have real estate that appreciates at 4% a year, let's just say that house cost $100,000 to be simple for this example. Obviously, they cost a lot more than that, but we'll keep it for this example. Well, if you bought that house for $100,000, but you use leverage and you only put 25% down, now what we're talking about is a $25,000 investment. But that house appreciated 4% that year. That 4% is on the $100,000 value. So that means your gains from appreciation are 4,000. So we'll go back to our calculator and we'll put in 4,000 divided by 25,000. And what we get is a 16% return on investment. You only put $25,000 in. You take that $4,000 of gains that you earned, you multiply that times 4 because you've bought 4 properties in this example. Now you're all in for 100,000 at a 4% appreciation rate, but what you earned is $16,000 of gains. So that just shows you how you really got to understand. You got to be a good steward of your money, because we just talked through how 4% real estate appreciation is better than 10% of something else that can't use leverage. And everywhere across the 5 profit centers, there are misunderstandings like that. That's what we're passionate about, helping everybody see.
And I love that. And that's a really great example, Greg, right? I love it. I think that saw Pablo's brain cells maybe just pop. I think maybe you're going gray now a little bit like me, because we're getting some hardcore financial education in you, which I love, right? You go grayer the more hard, financial education you get.
Is that what it is? I hope to go really
my
gray then.
That's my excuse, right? But I want to drive the point home. What Greg just went through really is like 2 of the 5 profit centers. What you just said there, Greg, at the end, I don't want to lose. That is a portion of what we can talk about with all 5 profit centers, right? That's why you need to get on the phone very very bluntly, jump on the phone with JWB. What is it, Greg? Chat with JWB.com.
Yeah, you could just send an email to keep it easy. info@jwbcompanies.com.